The more time that passes, the clearer it becomes that this moment may represent something far larger than a single regulatory action. What initially appeared to be a dramatic but isolated financial intervention is now being examined as a possible signal of a deeper transformation taking place inside the global economic system. Because in today's interconnected world, decisions about capital flows, asset control, and financial oversight rarely affect only one country. They ripple outward, influencing investors, institutions, and governments across continents. And that is exactly what appears to be happening now. In the hours and days following the announcement, financial institutions around the world began conducting emergency reviews of their exposure to Canadian markets and the networks connected to the frozen assets. Large investment banks assembled internal task forces composed of legal advisors, risk analysts, and compliance officers to determine whether any of their operations could be indirectly affected. Hedge funds and asset management firms began examining complex portfolios that included derivatives, energy investments, and cross-border financial instruments. These reviews were not driven only by the value of the frozen assets themselves. In fact, $13 billion, while substantial, is not large enough on its own to destabilize the entire global financial system. What made the decision so significant was the precedent it seemed to set. If Canada had demonstrated the willingness and ability to intervene in cross-border financial structures at that scale, it suggested that the boundaries of regulatory authority might be broader than many investors previously assumed. For decades, international finance has operated under a general assumption that capital, once invested across borders, would be relatively insulated from sudden sovereign intervention except in extreme circumstances. Markets depend heavily on that expectation of stability. Investors place money into foreign projects precisely because they believe the legal and regulatory frameworks governing those investments will remain predictable. But Canada's move introduced a new layer of uncertainty, because it suggested that under certain conditions, governments may be prepared to reassert control over financial flows that intersect with national economic stability or strategic interests. That possibility has forced many institutions to reconsider how they evaluate risk in an increasingly complex global economy. Inside major financial centers, the conversations have been intense. On Wall Street, executives have been meeting with legal teams to analyze the regulatory language used by Canadian authorities to justify the freeze. In London and Frankfurt, central banking officials are studying whether similar legal provisions exist within their own regulatory frameworks. In Asia's financial hubs, particularly Hong Kong and Singapore, investors are quietly reassessing exposure to North American financial instruments that might be affected by similar interventions in the future. These reactions illustrate an important truth about global finance. Markets are not only driven by numbers and balance sheets, they are also driven by expectations about the rules of the system. When those expectations change, the consequences can spread quickly. Currency traders, for example, have been watching the Canadian dollar closely since the announcement. Although the currency initially experienced volatility following the freeze, the reaction has been more nuanced than many analysts expected. Some investors interpret Canada's decisive action as a sign of regulatory strength and economic sovereignty, factors that can actually reinforce confidence in a country's financial stability. Others worry that aggressive intervention could discourage future foreign investment. Both perspectives are influencing how markets respond. Meanwhile, international energy markets are also paying close attention to the situation. Canada is one of the world's largest producers of oil, natural gas, and critical minerals essential for modern technology and energy infrastructure. Many of the investment structures examined by regulators were connected in some way to projects within these sectors. As a result, analysts are now studying whether the freeze could affect financing for energy development, infrastructure expansion, or resource extraction projects. Energy markets operate on long timelines. Projects often require billions of dollars in financing and take years to develop before they begin generating revenue. If investors perceive increased regulatory risk in certain regions, they may adjust their investment strategies accordingly. That could influence where capital flows in the future and which countries attract the largest infrastructure investments. At the same time, geopolitical analysts are examining the broader implications of Canada's decision within the context of international competition. Over the past decade, economic influence has become one of the primary tools through which nations project power on the global stage. Trade agreements, investment policies, and financial regulations are increasingly intertwined with diplomatic relationships and strategic interests. In this environment, financial actions can carry political meaning. Freezing assets connected to major financial institutions may not only protect domestic markets, it may also send signals about how a country intends to position itself within the evolving balance of global power. For Canada, a country traditionally seen as a cooperative partner within international economic institutions, the move represents an unexpected display of assertiveness. Despite having a smaller population and domestic market than some major economic powers, Canada possesses significant advantages in global finance. Its banking sector is widely regarded as one of the most stable in the world. Its regulatory institutions are highly respected, and its natural resources provide enormous economic leverage. By exercising regulatory authority in such a visible way, Canada has demonstrated that it is willing to use those advantages to protect its strategic interests. And that demonstration has captured the attention of governments around the world. Some policymakers view the decision as a potential model for how smaller but economically sophisticated nations can assert influence within a financial system often dominated by larger economies. Others worry that similar actions could contribute to fragmentation within global markets if countries begin intervening more frequently in cross-border capital flows. International financial organizations are now watching closely. The International Monetary Fund and other global institutions have reportedly begun analyzing the legal mechanisms used by Canada to implement the freeze. These organizations are responsible for promoting financial stability across international markets, and any precedent involving sovereign intervention in cross-border assets attracts careful scrutiny. Legal scholars are also examining the implications of the decision. The freeze was justified under provisions related to systemic risk and financial stability rather than explicit accusations of wrongdoing by foreign entities. That distinction is important because it allows Canada to defend its actions as regulatory prudence rather than economic retaliation or political targeting. This subtle legal framing may prove crucial in determining how other nations interpret the decision. If the move is seen primarily as a defensive measure designed to protect financial stability, it may attract less international criticism. But if it is interpreted as a strategic maneuver aimed at shifting financial influence, it could spark debates about how far governments should go in regulating cross-border investment networks. Meanwhile, within Canada itself, the political implications are significant. Government leaders have emphasized that the decision reflects a commitment to protecting the country's economic sovereignty and financial stability. Public statements from officials have stressed that the freeze was implemented after careful review and was necessary to address risks that could affect long-term economic health. Yet even within domestic policy circles, there are ongoing discussions about the broader consequences of such an action. Canada has long benefited from its reputation as a stable destination for international investment. Maintaining that reputation while asserting regulatory authority requires a delicate balance. Too much intervention could discourage foreign investors, while too little oversight could expose the economy to vulnerabilities created by external financial influence. This balancing act is one that many countries are now confronting. Globalization has created unprecedented opportunities for capital to move across borders, financing projects and industries that drive economic growth. But globalization has also created complex networks of influence that can sometimes operate beyond the reach of traditional regulatory frameworks. As those networks grow more intricate, governments may feel increasing pressure to develop new tools for monitoring and managing financial risk. Canada's decision may therefore represent part of a broader shift in how nations approach economic sovereignty in a world defined by interconnected markets. The freeze of $13 billion in Wall Street-linked assets is not merely a technical regulatory action. It is a demonstration of how financial power, legal authority, and strategic calculation intersect within the modern global economy. And as markets continue absorbing the implications, one thing is becoming increasingly clear.